Hi guys. Today we will analyze Northrop Grumman stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market. The long and short-term trends are both positive. Strong support levels are around $440 and $410. Next strong support levels are around $368 and $345. Strong resistance level is around $477. In the last month the stock has been trading between $432 and $474 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 0.8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 5 years. We see that the average profit margin of the stock has been around 11% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 79% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Northrop Grumman Company: bad, average, and good. First scenario. Northrop Grumman will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 1%. Future profit margin would be a low, 9%. Future free cash flow to net income rate would be a low, 50%. In this case, the fair value of the stock today would be $266. Second scenario. Northrop Grumman will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 2%. Future profit margin would be average, 10%. Future free cash flow to net income rate would be average, 55%. In this case, the fair value of the stock today would be $335. Third scenario. Northrop Grumman will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 11%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $415. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 36.28. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Northrop Grumman, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 19. Again, I will use 3 different scenarios for Northrop Grumman Company: bad, average, and good. First scenario. Northrop Grumman will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 1%. Future P/E would be a low, 13. In this case, the fair value of the stock today would be $219. Second scenario. Northrop Grumman will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future PE would be average, 16. In this case, the fair value of the stock today would be $294. Third scenario. Northrop Grumman will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 19. In this case, the fair value of the stock today would be $381. As you can see, today the stock is overvalued, $467, even if we expect the company's high performance in future. The company has a great profitability rating, but there are some minor concerns on its financial health. Also, the company is expected to show a small growth in revenue, 3 to 5%, in the next 5 years. Based on that, the stock looks overvalued at the moment. I may consider buying the stock when the stock drops below $380. Company's strengths. Northrop Grumman Corporation is a leading American multinational aerospace and defense technology company. It's one of the world's largest weapons manufacturers and military technology providers. It currently leads the development of the B-21 Raider, a long-range, stealth strategic bomber that can drop conventional and nuclear weapons, James Webb Space Telescope, and the solid rocket boosters for NASA's Space Launch System program. The company has consistently delivered positive surprises to the street in recent years, regardless of whether defense spending is rising or falling, or a Republican or a Democrat occupies the White House. Defense prime contractors operate in an acyclical business. Analysts have a favorable view of the company's focus on international revenue diversification, and expect ongoing geopolitical tension to benefit sales and earnings going forward. Northrop has the opportunity for material revenue synergies from its acquisition of Orbital ATK. The company is mindful of shareholder returns, and has consistently raised the dividend at an accelerated rate, while also repurchasing stock. The company's return on assets of 14%, return on equity of 43% and profit margin of 16% are amongst the best returns of the industry. Risks. Northrop Grumman is a key supplier to the U.S. military, and thus vulnerable to debates over and potential cuts in domestic and international defense spending. The company is subject to a number of procurement laws and regulations, and evolving U.S. government procurement policies, and increased emphasis on cost over performance could adversely affect Northrop's business. The defense industry is competitive, with other deep-pocketed players. Northrop is the prime contractor on most of its contracts, and is thus also dependent on subcontractors and suppliers. The company's international business exposes it to additional risks, including risks related to geopolitical and economic factors, laws, and regulations. There is a risk that upstarts, like SpaceX, will threaten incumbents' oligopoly in space contracts, such as space transportation programs and satellites. Northrop has a relatively high proportion of classified work, which limits our visibility into the business. The company is under constant pressure to build its backlog. Based on estimates for the next 5 years, the company will show a small growth in revenue and earnings per share. The EPS will grow by 6 to 8% on average per year. The revenue is expected to grow by 3 to 5% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.